Wall Street megabanks have been flirting with blockchains and crypto for the better part of a decade. And now that the regulatory shackles are finally coming off, we're about to find out how they really feel.
How do they feel about that?
Are we going to see banks flooding the market with crypto products and services? Or are they just going to keep shunning crypto in favor of their own private permissioned blockchains that nobody uses? Stay tuned to find out where the relationship between big banks and crypto is going, and why this time around, crypto can't lose. Goldman Sachs. It's not a name you hear every day on crypto Twitter, but here they are making the news for planning to spin out their blockchain division. Once upon a time, news of a 160-year-old megabank pulling something like this would have sent shockwaves throughout the community. We would have debated whether Wall Street's incursion into our turf should be celebrated as mass adoption or condemned as a brazen land grab. But by now, we're so used to TradFi institutions fiddling around with blockchains that these stories have become background noise. We have heard many times about the endgame, which has every real-world asset tokenized on-chain, and how this is going to save or make some people trillions of dollars. Maybe it will be as fantastic as advertised, but the current state of Wall Street blockchains seems rather less impressive. Blockchains offer a badly needed upgrade to the outdated infrastructure on which much of TradFi runs. To give you an example, more than 1 billion trades take place on the New York Stock Exchange during an average session, which is about 6.5 hours. This might make you think, well, golly, they must be processing these transactions very quickly. But nothing could be further from the truth. Depending on the asset, market participants have to wait as long as several days for transactions to be completed. Until 2017, it was 3 days for securities. Earlier this year, the SEC finally changed this to 1 day, but that's still a really long time. Can you imagine if you tried to buy some BTC on an exchange and you had to wait a whole day for the transaction to be finalized? Of course not. That's just outrageous and But why? What on earth could make a simple transaction of money and financial assets take so long? Well, in the case of the NYSE, it's because there are so many intermediaries and steps for cash and assets to pass through before reaching buyer and seller. Cash moves on one set of rails, securities move on another. The infrastructure is highly siloed. In a world where blockchains existed for 15 years, one has to wonder why transactions in financial markets are still so inefficient. Blockchains present a very good solution to these inefficiencies. They streamline settlements, payments, and trade finance. They can enhance data integrity and transparency, and they can give a competitive advantage to institutions who use them over those who don't. It's no wonder then that big banks like JP Morgan Chase, HSBC, Wells Fargo, and many more have developed their own blockchain projects. Of course, regular viewers of this channel will know that there is a key difference between their blockchains and the ones we use in crypto, namely that our blockchains are public, permissionless, and decentralized, and theirs, well, they're not. Theirs are literally just centralized databases. To us, properties like decentralization are not just incidental, they are the whole point. They are non-negotiable conditions that make crypto possible. But you know how it goes. A lot of these Wall Street types want our chains, but not our crypto. Some of them won't even say the C word. Instead of crypto and blockchains, they're all about digital assets and distributed ledger technology. Everyone knows they owe their tech to Satoshi, but they'd rather not admit it. Anyway, since these chains are not concerned with decentralization, transactions are verified by a small number of nodes. And this means that transactions are faster and costs are lower than on public chains. High performance and scalability are much easier to accomplish on a private network than on, say, Ethereum, for example. The controlling institution decides who can participate in the network while retaining oversight of data, transactions, and network rules. And this has the added benefit of making compliance with KYC, AML, and other regulations easier. These qualities make private and permissioned chains well suited to the needs of the controlling institutions. However, there is a trade-off for the clients, who are supposed to be the ones benefiting from the use of these blockchains. Clients must, for example, rely on the governance of the controlling entity. Trustlessness and transparency, well, they go out the window, and this to some extent defeats the point of using a blockchain in the first place. The security of these chains will also fall short of the decentralized public networks used in crypto. No doubt the likes of JP Morgan and HSBC will have almost unlimited financial resources to throw at security, but with the network consisting of centrally controlled nodes, there are necessarily fewer points of failure that threaten the security of the entire chain. For certain use cases, these trade-offs are worth it. Many of the use cases of blockchains on Wall Street pertain to internal operations and client-facing services. For example, enterprise blockchains can improve efficiency in settlement speeds, custody, FX transactions, and the like. When it comes to client-facing services, trustlessness and decentralization are of less importance because the relationship between financial institutions and clients is already one based on trust. If you entrust someone with your assets, you probably want them to have control over all of the infrastructure that said assets will come into contact with.
We regret to announce that the Bro Crypto podcast is sponsored by the Coin Bureau Deals page. This is the place where you can find the very best deals and promos in the crypto space. From massive trading fee discounts to insane sign-up bonuses on some of the best crypto exchanges. You'll also find crazy discounts on hardware wallets, and you can sign up for our exclusive Coin Bureau Club there too. So, check out the Coin Bureau Deals page today. Otherwise, you'll have to keep listening to these two idiots.
Hell, that's the problem a lot of crypto bros have these days. They're inside too much, 24/7 on the
computer. Open your inside. You need to get out. You need to get some sun. You need to get some vitamin D.
That's all fair enough. However, shared infrastructure is another story. Blockchains are supposed to address the current siloed nature of banking. This means giving the entire industry new rails to run on, because the efficiencies and business model benefits of using a blockchain depend on many institutions using the same chain. The inefficient clearing and settlement processes of the New York Stock Exchange, for example, could be handled by smart contracts all on a single chain. And indeed, the Deposits Trust and Clearing Corporation, which is responsible for the NYSE's infrastructure, is already working on a blockchain pilot. If this works out, it could benefit the entire industry. But until this kind of shared infrastructure materializes, then individual companies developing their own proprietary, private, and permissioned chains are really just reproducing the same siloed system. And this is one of the many problems facing the current cohort of Wall Street blockchains. Despite being technically easier to scale, they are fragmented. And despite being technically achievable, interoperability is limited. It's a little like Ethereum's Layer 2s. Individually, they represent a huge leap forward for a legacy system. But in aggregate, there are so many of them that siloing becomes an issue. For Ethereum, this means that liquidity is fragmented, and newcomers are overwhelmed with the size of the ecosystem and its many overlapping parts. For Wall Street, this means that there are no obvious contenders for a blockchain that many market participants could benefit from. After all, institutions are understandably reluctant to rely too heavily on a system created and controlled by their competitors. If any of the current TradFi blockchains have seen a lot of adoption, then their controlling institutions are being very secretive about it. Most seem to be used only for occasional transactions and issuances, making them look more like an experimental gimmick than a transformative system upgrade. One of the more successful projects is HSBC's Orion chain. But 5 years on from its inception, even this blockchain has only been used to issue a handful of bonds, including HSBC's own. Last year, Orion was used by the European Investment Bank to issue a £50 million floating rate bond. Earlier this year, Orion facilitated a digitally native green bond for the Hong Kong government to the tune of $6 billion Hong Kong dollars. These are certainly important milestones for the advancement of asset tokenization. And perhaps we're just being a bit impatient. But bank-owned blockchains like Orion took a long time to build for something that is used so seldomly. Another victim of this conundrum is Goldman Sachs, which, for an ancient institution, is surprisingly forward-thinking about blockchain and crypto. More on that in a moment. 2 years ago, Goldman launched its own digital assets platform, GSDAP, with an issuance of a €100 million digital bond for the European Investment Bank. And this was a good start, but since then it has only executed one more issuance, a tokenized green bond for the Hong Kong government. Funny how it's the same actors in each play. In any case, building an enterprise blockchain only to dust it off once a year seems like a bit of a waste. And perhaps this was a wake-up call. Goldman seems to have recognized the problem of blockchain fragmentation and siloing on Wall Street and is now trying to do something about it. The megabank recently announced its intention to spin out GSDAP within the next 12 to 18 months. In other words, Goldman Sachs will be renouncing ownership of its blockchain. The idea is not to make GSDAP an independent company just for the sake of it. Rather, Goldman Sachs wants it to become an industry-owned piece of shared infrastructure, the kind that could be used by and to the benefit of many participants. How much of this decision was a noble act in service of Wall Street, and how much a shrewd move to leapfrog rival TradFi blockchains? The answer will depend on details such as how much of its stake in the blockchain Goldman Sachs intends to keep. Goldman says that the goal is for this platform to be owned by a new entity, although how this will make DAP industry-owned remains to be seen. Now, this is all very interesting, but what does it mean for crypto? Well, as we have seen, a lot of Wall Street's tinkering with blockchains is consciously separate from the world of crypto. They are borrowing our tech and building completely detached infrastructure of their own. The relationship between big banks and crypto over the years has been quite volatile, with sentiment more or less tracking market conditions. For example, much like the present moment, everyone wanted a piece of crypto back in the bull market of 2021. Then, after a catastrophic year in 2022, crypto became radioactive to many institutional investors. However, throughout the swings in sentiment and prices over the last few years, one variable has remained constant. And that is the confused and, quite frankly, hostile regulatory environment maintained by the Securities and Exchange Commission. And this is the real reason that US institutions have been so constrained in what they can do with crypto. It's the reason banks like Goldman have been able to offer their clients crypto derivatives, which are not regulated by the SEC, but not spot crypto trading services. Goldman executives have made it clear that they wouldn't touch the crypto spot market until US regulators gave their blessing. One area in which banks have been given regulatory clarity over crypto is in custody. A Biden-era SEC rule, known as SAB 121, outlined rules for crypto custody so onerous that they are tantamount to the SEC telling banks, yeah, you don't want to do that. And this was pretty bold since the SEC does not even have regulatory authority over banks in the US. And we are all for encouraging self-custody, but did they have to be so passive-aggressive about it? Unsurprisingly, SAB 121 proved highly unpopular in all corners of Washington, Wall Street, and beyond. The Senate voted to axe it earlier this year, but President Biden then vetoed that motion. By making it all but impossible for banks to custody crypto, the SEC successfully foreclosed the possibility of many crypto products and services that TradFi institutions might otherwise be offering. Of course, a few things have changed in Washington recently. The crypto industry poured vast sums of money into supporting pro-crypto candidates in this year's US elections, and many of them won their races. And now that enough backs in Washington have been scratched, we can very likely look forward to crypto's back getting a scratch or two in return. SAB 121 is now reportedly a top candidate for the chopping block in 2025. And if it is repealed, it will most likely be replaced by rules that make it commercially viable for banks to custody crypto. This alone would be huge. For one thing, banks would no longer be confined to crypto derivatives, which do not require custody of the underlying assets. They could offer spot trading for crypto directly to retail and institutional clients, as they already do for stocks and commodities. This would make crypto accessible to conservative and casual investors alike, including millions of Americans who might be curious about investing in crypto, but not enough to want to maintain crypto wallets or accounts on exchanges. By extension, banks could become key infrastructure for fiat crypto on-ramping and crypto fiat off-ramping. Many of us live in jurisdictions where reliable and convenient on- and off-ramps are in short supply. So if these were made available through the banks that most people use every day, it would be a huge change and likely onboard a whole lot more marginal buyers to crypto. It's not hard to imagine banks bundling custody, trading, lending, staking, and yield-generating products, leveraging their scale and regulatory advantage to bring crypto-native financial products to Wall Street and Main Street alike. All of this is likely to be doable from a regulatory standpoint, so there would be little reason for banks not to expand their offerings in this way. But while regulatory clarity on matters of custody and beyond will be a huge boon for crypto in the US, the road ahead is less clear when it comes to the rather important matter of asset tokenization. TradFi and crypto are in agreement that real-world assets of all kinds should and will be tokenized on blockchains. We agree that the potential benefits of mass tokenization are so great that it's almost an inevitability. But disagreements begin when we ask the question of which blockchains? To us, RWAs are one of the most promising crypto narratives and use cases out there. But for some on Wall Street, asset tokenization and crypto never need be in the same sentence. The private and permissioned blockchain infrastructure that they have built to prepare for our tokenized future has made quite sure of that. Then again, crypto has friends in very high places now. We have in our corner the largest asset manager in the world, BlackRock, who gave a massive vote of confidence in public blockchains by launching its first tokenized product, a money market fund, on Ethereum back in March. The Biddle Fund is the largest on-chain fund of its kind and was recently expanded to 5 more public chains: Aptos, Arbitrum, Avalanche, Optimism, and Polygon. This bodes well for RWAs as a use case of crypto per se. One wonders what BlackRock's Wall Street neighbors will have made of this, having spent the last decade building and testing their own chains to host tokenized assets of this kind, only to be used quite sparingly. If the likes of Goldman, HSBC, and JP Morgan are indeed going to capitulate and start supporting asset tokenization on public chains rather than the chains they control, they are not showing any signs of it so far. Goldman's intention to spin GSDAP out into a platform owned and used by the entire industry is a tacit acknowledgement that the current siloed private infrastructure is not the best way forward for asset tokenization. If this logic goes much further, it might start to look like an admission that public blockchains are a superior choice. We don't expect big banks to abandon their own chains in any event, but is it technically viable for them to interact with public chains? Will we see an interoperable future where banks handle the tokenization process in-house, and then the tokenized assets are wrapped and traded on public chains? It's an interesting proposition. Many of Wall Street's blockchains are a contiguous ecosystem, in the same way that EVM chains are. They use the same DAML language, and quite a few are part of the same network called Canton. Both DAML and Canton are developed by Digital Asset, specifically for private, permissioned institutional users. These chains are therefore interoperable with each other to some extent. However, interoperability between private and permissioned blockchains and public and permissionless chains is less straightforward, but neither is it unfeasible. Cross-chain communication can be accomplished by interoperability systems like Hyperledger Cactus and Polkadot, or middleware solutions like Chainlink and Axelar. Or custom oracles can facilitate communication between DAML-based systems and EVM or other public chains by securely passing data and events. And crucially, assets recorded on a DAML-based chain can be tokenized or wrapped into ERC tokens for representation on EVM chains. So the possibilities are there. Whether or not this will be the practical solution for the parallel ecosystems of crypto and Wall Street blockchains to meet in the middle on asset tokenization remains to be seen. The good news is this kind of convergence between big banks and crypto would only need to happen on a small scale for RWA-adjacent cryptos and the smart contract blockchains that they exist on to see massive inflows of capital. The pie is humongous because it consists of basically every single asset in the world that is not already on a blockchain. Even a sliver of this pie landing on crypto's plate would be huge relative to the size of the total crypto market cap. And as long as we have champions like BlackRock and, say, the White House, and both houses of Congress, then we can probably look forward to more than a sliver and maybe even a big, fat slice. All right, folks, that's our current read on the future of big banks, blockchains, and crypto. But now it's your turn. What will the intersection of banking and crypto look like 4 years from now? Let us know what you think in the comments down below. And if you got something out of this video today, go ahead and drop us a like and make sure you are subscribed and have your bell notifications turned on as well so you don't miss our next upload. As always, thank you very much for watching and I will see you in the next one. This is Nick, signing off.